Welcome, everyone. This is Esther Aguilera, President and CEO of the Latino Corporate Directors Association. And I will say that we are very excited. We've had a series of sessions starting in late July, focused on leadership during a time of crisis, focused on the pandemic, our economic situation, as well as the social unrest and addressing systemic racism. This is one of our last virtual convenings for the time being. We are going to come back in the first quarter of next year with additional sessions because there's just so much to track as the economy and as businesses and the pandemic takes fold. So we want to stay current with covering those topics. So today's theme and topic is preparing for the 2021 proxy season, shareholder activism in a post-pandemic economy. I want to thank KPMG, who's been our presenting sponsor and partner throughout the series of meetings, and they're just an excellent supporter of our work. We really appreciate working with everyone at KPMG, including Jose Rodriguez, Susan Angeli, are very, very invested. For this session, I want to thank Vincent and Elkins for partnering with us once again to help put this panel together on the topic. So Lawrence Elbaum, thank you for teaming up with us and for always being a great partner. And also Bank of America, who's been a supporter of LCDA since the very beginning and has been pivotal to our growth. So Amy, we had Brian Moynihan host us. They host our annual meeting last year in New York, and he was phenomenal and the whole team. So Bank of America has invested in a really good cause. So thank you and the entire Bank of America team. Before we get started, I just wanted to quickly highlight for our attendees and our panel that earlier today, the Latino Corporate Directors Association announced and released a scorecard. We have an initiative called Latino Voices for Board Equity, where we are tracking and staying on top of the appointments of Latinos nationwide, but we're starting in California. And it's an initiative that was launched with 6 national organizations. So this is a key stakeholder, the U.S. Latino community, speaking up and saying that the number of Latinos on boards is awfully low and something needs to get done about it. So this initiative is about taking action. And a core pillar of the initiative is to track appointments. And in California, as you know, we had we have a bill that requires the appointment of women, which is needed on company boards. But earlier this year, when we did an analysis, since the bill was enacted, there were about 511 women appointed to California boards. And of the total, only 3.3% were Latina, about 78% were white women, and then everything in between. Latinos were the least likely and largely left behind. And so we felt it was very important to continue this tracking. And now that we have AB 979, which now requires race ethnicity, we're also tracking the status because we don't want to come back a year and a half from now and find that the numbers are not moving. And so far, the bill was introduced in July, and the numbers are not promising at this time, but there are about 240 appointments, board appointments, that were made between July 1 and October 31st. And of those appointments, only 2% or 5 were Latino or Latina. 71% white, and we have the stats for the rest of the demographic And then among the women, again, only 2 Latinas appointed. So we're going to have this scorecard tracked every quarter. So we're measuring the progress. We're writing to the companies, engaging them because they keep saying they can't find the talent. So we're going to make sure that they find the talent and help them with that. But with that, I think it's relevant to the panel and discussion today. But I know that you have, we shared the link for the reports and expect more to come there. We'll keep an eye on that. So with that, I want to turn it over to our moderator and thank Rafael Diaz Granado for volunteering to help us out, kind of get this conversation going. He's a former chief restructuring officer with GE Healthcare. He's a director at Angeles Investors, at Massachusetts Growth Capital Corporation, and Paragon. Rafael, I'm going to hand it over to you. Thank you.
Great, Esther, thank you. Thank you so much. I should also mention I am director of the Latino Corporate Directors Education Foundation, which we didn't put on the list, but it's actually one of the things that I'm most passionate about, and truly appreciate the opportunity to moderate what I know is going to be an exciting panel. I'm looking over all the little boxes and I see a number of folks that we know, and actually at least 2 or 3 people I sit on boards with. So I'm glad to see such participation from the LCDA community. A couple of just quick comments before I move to introducing our panelists. Because the first thing that I would say is we want this to be interactive. You guys will have been seeing as you're participating in the Zoom, Ozzy and other members of the LCDA staff sort of sharing things on the chat. We don't want this to be one direction, us speaking to you. We want to kind of hear from you as well. So absolutely feel free to put in questions in the chat, and we'll make sure that that gets incorporated into the panel. And I guess the other thing that I wanted to do is just, the title of the panel is Post-Pandemic Economy, but clearly we're still in the middle of this, right? And, there is a lot of challenges, unprecedented challenges that are being felt by businesses and by boards as a result of the pandemic. And, in the context of the pandemic and in general, boards contend with the threat of shareholder activism. And there is increased scrutiny right now as, business results perhaps are challenged as a result of economic slowdown and some of the things that are happening because of COVID-19. And so, how are activists responding to the COVID-19 crisis? How can companies plan and react effectively to the threat of shareholder activism? These are some of the things that we're going to touch on today with an unbelievably talented group of panelists. The other thing that I want to highlight is that it's not just the ongoing pandemic, the economic crisis, but there's also social unrest that is resulting from the Black Lives Matter movement. All of these things are bringing the S in ESG, which is a concept we're all familiar with. They're bringing that front and center. And so shareholder activists are bringing issues like workforce diversity and racial justice sort of to the forefront of the agenda. These are issues that are at the core of the LCDA mission as well, as we advocate for more Latino representation on corporate boards. And so we often find ourselves on the same side as some of these activists as they push for championing diversity in the boardroom. So I think we've got a unique group of experts here with us today. We're going to get some interesting and different perspectives. And what I want to do is go ahead and ask everybody to introduce themselves briefly. We are, we've shared everybody's bio, but always getting a little bit of context in terms of your trajectory, what your current portfolio looks like. And I'm going to do it kind of in alphabetical order by first name. So I'll start with Amy.
Thanks for having me. So hi, Amy Lessauer. So I'm the Global Head of Activism and Trade Defense at Bank of America. And to give you some perspective of what that means, I work with companies. And so Bank of America, unlike some other banks, we only work with corporate clients to help to prepare them for shareholder activism, help them with shareholder engagement best practices, and also to work with them on live situations in which there is a shareholder activist looking to force change at the company. And so over the course of my career, I've advised well over 150 companies publicly dealing with activism situations or public hostile takeover attempts. Thank you.
Great, thanks, Amy. Welcome to the panel. Let me go to John.
Sure. Thanks so much. Hello, everyone. I'm John Hepner, head of U.S. Stewardship and Sustainable Investments at Legal & General Investment Management Americas. Legal & General may not be a household name for many of you. It's the largest asset manager based in the UK, about $1.5 trillion of assets under management. My role is to help design and implement the proxy voting strategy, the engagement strategy in the Americas for our assets, about a third of which are index-based, which means we likely have a small piece of every one of you who's a director or who are an executive on the phone today. We probably have a 0.5% or 1% of your company. And we tend to take quite principled views on our votes. So we may be often voting against you or voting against someone on your board. And so we'll spend some time talking about that. But that's my role, is to help design that policy really to be in the best long-term interest of our underlying clients. I'll say right up front, we are not activists. My corporate clients would be very upset if I use that term. We're active owners. So really looking at the long-term, we do essentially hold a slice of the whole market. So we're trying to engage with our companies or vote proxies in a way that enhances the value of the whole market. So I'll pause my remarks there.
Great.
Thanks.
Thanks so much, John. I'm sure we'll get to hear a little bit more detail in terms of how you think and how you approach those votes. Next, Lawrence, first, thank you for being a sponsor of the session, but also for helping kind of create this practice at V&E. Will you tell us a little bit more about that?
Sure, I'm happy to. And if I speak too long, you could play Academy Award music behind you on that piano. Very nice to meet everyone. Thank you for having us. I'm Lawrence Elbaum. I co-head V&E's Shareholder Activism practice. We focus on defense of boards and management teams. Our practice is industry and market cap agnostic. So we work with companies of all sizes, from under 100 million market cap to over 20 billion market cap. And we cover the widest spectrum of industries you can imagine. We're a global law firm with 13 offices. We got a big team, and there is no firm in the United States that has defended as many boards and management teams as we have over the past 6 years.
Great, Lawrence. Well, thank you so much for joining us. And then last on the panel, we've got Mark Goldstein from ISS, and I'm going to ask Mark something a little different, which is, we do want to hear a little bit of that trajectory and portfolio, but ISS plays such an important role in proxy and proxy voting. If you could give us a little bit of context and ISS's perspective on sort of the current state of shareholder activism. So you get basically the first laboring oar of this panel, Mark.
So thanks. I'm happy to be here. I'll echo everyone else's thanks for organizing this, and thanks to the participants. My name is Mark Goldstein. I'm head of the Benchmark US research team at ISS. Like many of the other folks on this webinar, I'm a lawyer by background, but I have been with ISS now for 23 years, about half of that in charge of Japanese research, but the last dozen years or so in a variety of roles on the US side, including now head of the US Benchmark research team. We are responsible for the research and proxy voting recommendations for annual meetings, special meetings, et cetera, for pretty much every company listed in the US capital markets. Obviously, we have other groups within ISS that cover proxy contests. That's our special situations research team, and other markets. But my portfolio is US companies. So I'll start by saying, look, 2020 is the year of COVID. It's not really any great surprise to anyone. It's true in the world of corporate governance and proxy voting, just as it is in the wider world. Early on in the pandemic, some commentators claimed that investors would be forced to go back to basics and just focus on earnings, that environmental, social, and governance issues would somehow be luxuries that investors could no longer afford. But that simply didn't happen. Instead, the pandemic highlighted the importance for companies of providing a safe workplace, paid sick leave, other things that fall under the rubric of human capital management. And it also highlighted the contrast between companies whose executives shared the pain of workers and shareholders through meaningful reductions in compensation, and companies that contrived to insulate their executives by maintaining their compensation even as workers were being laid off and shareholders were suffering losses. So already in 2020, shareholder concerns about environmental and social issues manifested themselves in a record number of shareholder proposals on E&S topics, winning majority support. 21 such proposals year to date. Shareholder concern about compensation issues is likely to be felt most strongly next year, however, when shareholders are voting on 2020 pay decisions and the full details of companies' incentive adjustments and discretionary awards become available in next year's proxy statements. Of course, the pandemic isn't the only thing going on in the world that has impacted investor stewardship and proxy voting. The racial justice protests this year and companies' expressions of support for their goals have had the effect of casting a spotlight on diversity, or in many cases, the lack thereof, in boardrooms and executive suites. Investors' focus and engagement on gender diversity over the past few years has helped to bring about significant progress. And we're now likely to see more focus on racial and ethnic diversity among investors because progress has been slower on that front. One obstacle to shareholder engagement on this issue has been the lack of clear disclosure at many companies in the absence of any disclosure requirements in SEC regulations or stock exchange listing rules. ISS and some investors have been writing letters to companies urging them to disclose diversity information voluntarily, but we recognize that some directors are uncomfortable with such disclosure, and so there are times when we have to use our best efforts to guess based on names, photos, bios, whatever else we can find. In that effort, groups like the LCDA are a big help to us. As I'm sure many of you have heard, ISS is updating our US benchmark policy to recommend votes against the nominating committee chair where a board lacks any racial or ethnic diversity beginning in 2022 in the absence of mitigating factors. We will accept disclosure in the aggregate along the lines of 20% of our directors are people of color, and we'll supplement companies' disclosure with what we know from other sources, including disclosure at other companies. We're pretty confident in our data, but if we do mistakenly tag a board as being all white when it's not, we'll be very happy to be corrected. So what about shareholder activism? The number of proxy fights was down in 2020 to the lowest level since 2011. The median market cap of the targeted companies was also way down after reaching a record high in 2019. This surely reflects the effects of the pandemic. Look, activists didn't want to be seen as heartless ghouls preying on wounded companies struggling to survive. And traditional activist strategies such as urging a big buyback program or putting a company up for sale were simply not going to be very compelling to ordinary shareholders this year. Xerox is a good example where an activist pulled back from a fight because the time just wasn't right. But where activists did decide to stick it out, they actually had greater success, the highest success rate in more than a decade, where success is defined as getting at least one nominee elected to the board. That's particularly significant given that a higher proportion of contests this year were for control of the board. This high success rate may be because activists were limiting themselves to the most promising targets, or maybe because as the overall market recovered, investors were willing to take a chance on electing activist nominees at companies whose share prices continued to languish with no quick recovery in sight. Looking ahead, we know that there are activists with plenty of dry powder, and we know there are companies whose share prices remain far below pre-pandemic levels. There are some signs that hostile takeover bids may be increasing compared to the low levels we've seen in recent years during the long bull market. We saw a wave of short-term poison pills adopted this spring, more than 50, and it's likely that some of those will be extended next year if share prices of those companies still have not recovered. Investors were largely forgiving of boards for adopting those pills because they didn't want to see an opportunistic takeover based on the prices prevailing in March or April. But these pills are aimed as much at activists as it would be acquirers, and shareholders won't necessarily want to see companies extend the protection if the underlying business continues to stagnate. Shareholder receptivity to a new or extended pill, or for that matter to an activist campaign, is going to depend heavily on the facts of each case. What we do know is that activists will try many different tactics to appeal to the mainstream investors whose votes they need. That may include attacking the executives for a misalignment between pay and performance, or criticizing the company for poor governance and poor responsiveness to shareholders, or even in some cases, going after the company over environmental and social issues. Whatever is important to asset managers is fair game for activists to bring up. So boards should think of best practices in governance, compensation, and E&S issues as an effective activist defense and not just as a way to keep proxy advisors happy. So Raphael, back to you.
Great, thanks so much, Mark, and certainly very helpful context, and again, re-emphasizing the important role that ISS plays in sort of the way that boards approach these issues, and clearly the suggestions that you guys make around voting are something that every board takes very seriously. I want to perhaps bring Amy and Lawrence into the conversation. As we just discussed, the pandemic, the protests for racial equity have, brought the S and ESG into center stage with activists. And this is, something that Mark just highlighted in the ISS discussion. But, we're also seeing that in these areas, how can boards best respond to an activist that is bringing sort of a social concept, discussion to the table, and support, not support. What should how should the board react? And clearly this is something that is central to the LCDA mission. So we've had a good relationship with folks on both sides of the table, and wanted to kind of get perspective, perhaps Amy, starting with you, and then with Lawrence.
Yeah, sure. So one of the things that I say to everyone, I know Lawrence hears me say all the time, is I pride myself on telling companies things that they need to hear, not what they want to hear. And I always try to make it so that when we come in and tell our perspective on a situation, we always view it's better to hear it from us as your advisor than to hear it from your investor. So first and foremost, I would say, don't wait for someone to come in and tell you to make a change. You need to proactively look at your board and take an assessment of improvements that need to be made. And we think about the S, right? And we think about board diversity as one of those things on the agenda of a lot of investors. And I don't think even just activists, but I just think investors in general. I have conversations with companies all the time to say, are you thinking about this? And then the generic answer is probably, of course we are. And then you kind of really push them and say, but how aggressively are you thinking about this? Because this is something you really need to focus on. And so we actually, I joke about this, but we spend a lot of time, as you can imagine, helping a lot of our clients in the context of a fight, find directors to fill seats on boards when they feel vulnerable. But we're expanding that, and we're spending more time actually helping to make connections to find diverse candidates to some of the points that Esther made to start, which is you're hearing a lot that they can't find people, and we're going to try to push to say you can. So I think that's the first thing, which is you got to do things proactively. And second of all, I think that there's a real strong desire at this point for more information, just more data, right? So what is the information? What is the diversity perspective of your company, profile of your company? And a lot of companies don't necessarily feel comfortable giving that because I think they realize that it isn't going to look super positive. And one of the things that I'm encouraging companies to do is to say, listen, no one's going to, at this point, people are expecting it to look the way it probably does. But you need to get ahead of it because you need to now come clean, put it out there, and then you can start improving it alongside, pretty tough conversations with some of your investors. My view is if you don't go ahead and actually make those changes proactively, then you're going to be on the receiving end of whether it be shareholder proposals for these topics or even an activist, like a real traditional shareholder activist trying to use that against you. And we're already hearing that the big name activist funds are out there very aggressively courting diverse candidates, particularly women, to serve on their slates.
So let me just perhaps follow up for a second, because you were talking about, and I think one of the great value adds that B of A and your practice have is forcing the boards to be proactive. I saw a question on the chat from Marisol who was saying, kind of what's the grace period you give? So you're having this conversation with your CEO, your chairperson, your chair of NumGov, and you look around and there's not a ton of diversity, right? It's like, okay, we've got to figure this out. How much grace period should boards get, and how hard do you push them to get them ahead of the curve?
Yeah, so one of the things I think that works in our favor is that you every single year there's a nomination window, which is when someone who wants to put themselves forth for the company's board can do so. Every company has it. It's typically something between 90 and 100 days prior to the company's annual meeting. I always view that as that's a vulnerability for the company in terms of someone else coming in there and proposing someone you haven't already thought of. So I tell every company, you got to know what that window is, and you should be thinking about your own board's composition prior to that period of time.
Yeah, no, that makes sense. And don't come up with it after you've printed the proxy. That's an issue. Lawrence, thoughts on this from your perspective?
Yeah, I mean, look, when we hear from a board of any size that they don't know where to find diverse candidates, we tell them that that's just an excuse to not find diverse candidates, and it's a pretty bad excuse. And we start in terms of grace period and timeline. We start every year after the annual meeting results come in. The company will issue an 8K on a schedule 5.07 with annual meeting results on all proposals for directors, for comp, for other matters that are up for election and up for vote. And that's the scorecard on how the company is doing. Say on pay is how's management doing, and then the directors, they find out who's voting for, withholding, or voting against. And we strongly recommend at that point doing archaeology. Look at ISS and Glass Lewis. Look at your institutional shareholders. Maybe John, with nodding his head, could let us know whether their voting results are publicly available. But many institutional shareholders' voting results are publicly available. They're telling you how you're doing as a board. ISS may not actually be recommending against boards in certain circumstances, but they will note red and yellow flags in their narrative every year in the absence of a proxy fight. You got to take all that data in after that annual meeting and then think, what do I want my proxy statement to look like next year to show that we had a governance process around reviewing this information, considering dynamic changes to be made to the board and governance practices, and what's the timeline to get to that ideal proxy statement. The boards that have deliberate and intentional processes generally are going to be less of a target for activism. And if they are targeted with activism, they've got a plan well underway, which is one of the best defenses. You can never count on stock price improvement to get you out of a proxy fight. We always hope and pray that our clients are just going to miraculously start having a hockey stick stock graph. So you have to start looking at these other things. I found, and Amy and I are in a unique position because we're dealing with companies that have some sort of trouble. So there is a bit of a selection bias, but we find that when the boards believe that their seats are vulnerable, they will be more willing to listen to change, particularly when it comes to gender and ethnic diversity. It is an epidemic. It's weird to use the word epidemic to describe something else globally right now, but this is an epidemic going on in boardrooms, and you can leverage activism on both sides to start to fix it.
That makes sense, Lawrence. So let me just perhaps, you were talking about sort of what are some of the defenses. Do you guys find, Amy and Lawrence, in the conversations that you have, that it is easier to have the conversation when the board feels vulnerable? So, I mean, do you get pushback from boards that say, look, I'm delivering, sort of, weighted average return on capital that is way, above what other people are doing. My stock price is, off the charts. So, go talk to somebody else.
Well, I would say maybe that was a few years ago, but I'm finding actually some of the best boards now are actually much more open-minded to say, well, tell me what I need to know, because they don't want to be blindsided. And so what I've found is, yeah, they might say, we're doing really well, and hey, maybe, of course we're thinking about it. No one's actually outright rejecting of the concept. But of course, for someone who's facing an imminent threat, they're much more willing to move faster.
That makes sense. And Rich Horan, one of our participants, just put something on the chat. Also, curious, because I haven't seen too much of this, but it may be an upward trend. Lawsuits against the board just based on diversity. Is that something that you guys are seeing in your practices?
Yeah, we're reading about it. We're seeing what's happening, or companies are making promises in their corporate governance policies and in their proxy statements about diversity initiatives, and then past a certain grace period, you're seeing plaintiffs' lawyers bringing lawsuits saying those disclosures were faulty disclosures, and they're looking for damages. This is a sad statement about plaintiff securities lawyers, but they are looking for money to get out of these lawsuits. But here, the tip of their spear is better disclosures around the true intentions about diversity. It's a good way to give a board a swift kick to really get them to pay attention. I don't believe we've seen any of those go past a complaint stage. I don't know if any of them have been adjudicated, but those will be interesting to watch in the coming years. Boards always, and from an ISS and Glass Lewis and legal in general perspective, if you're making promises, big or small, in your proxy statements, you better back them up. The worst thing we've seen are boards that win proxy fights and save their jobs in year one with promises they can't keep.
Right.
Those boards are gone in year two.
Write the checks, but make sure you can cash them. I think that makes good sense. Let me perhaps pivot a little bit to echo something that Mark said at the beginning, which is we did seem to see statistics in 2020 as a result of the pandemic, and perhaps, and I think this may be a term of art, the heartless goals, not wanting to be seen as heartless goals. But we did see a little bit of a decrease in shareholder activism in the 2020 season. Companies were scrambling to respond to the pandemic. People were making decisions around that. Perhaps, John, you guys, as you've clearly said you're not activists, but you are active investors, and you're out there, sort of taking a position and making very clear that as long-term investors, you guys see value in boards and companies, sort of taking certain actions. What have you seen from impact industries? How did the activist focus shift? How did you guys think about it? How do you communicate about it in the interactions that you're having as institutional shareholders with your management and boards?
Sure. And actually, before I go right on that, I want to follow on one of the ethnicity on board comments, because I think it's important to see the investor perspective. And we didn't necessarily collaborate on this, but when Mark mentions that ISS sends letters to lots of companies asking them to disclose their diversity, and other investors also did that. That was a loose reference to Legal in General, right? So Legal in General, me personally, I used ISS data. I sent a letter to 44 chairmen in S&P 500 companies that had 0 assessed diversity on their board. And it was a nasty note saying, we're going to vote against your chairman or director of nomination if we don't see progress by 2022. And very fortunately, I don't know if we influenced Mark, but 6 weeks later, ISS made a benchmark policy, which is fabulous, and we're really excited, and we want to see where that drives. Now, one interesting thing
is, let me just point out that your ethnic diversity policy is just on the chat, so if anybody's interested. I am also curious, John, if you heard back from folks and what they said, because there seem to be some boards and some CEOs who say that they really shouldn't talk to their institutional shareholders. Don't ask me why, but want to see how that kind of two-way conversation is happening.
Sure, and I would be glad to be really transparent on this. I'll do it all in the aggregate, Mark, not to violate any licensing agreements. So there were 44 companies in the S&P 500. We also made the same policy in the UK, so rolled out to the FTSE 100. So a few kind of interesting, really practical feedback for everyone to be aware of. So first off, the data is pretty darn good, but not perfect. So of those 33 we reached out to in the UK, about 15 said we have some minor problem with the data. In the US, of those 44, there was only 1 or 2 companies that said we think the data is wrong in one way or another. So we're pretty high quality data. In terms of your question, Rafael, which was, what was the reaction? So we heard back from approximately half of these companies in the US. So not everyone. We're a large shareholder. I mean, tens of millions of dollars in every one of these companies we reached out to. And we heard back from half. And across the board, I didn't hear one pushback on the performance argument, right? So we lay this out by saying, diversity improves quality of discussion at boards. It helps retention. All the kind of normal performance arguments that I don't have to tell you guys about, but we had 0 pushback on that. The most interesting thing is the diversity of responses. about, if I were to say, the ones that were written by the chairman themselves, almost always the chairman, were the best because they admitted that they don't have diversity. The ones that were written by the IR team, maybe even the governance team, wrote 4 pages about all the diversity efforts, but didn't acknowledge this headline stat, right? So when we wrote this letter, it said, this is what we're going to vote on. But of course, this is just a leading indicator of all the other things. And so I guess that's my message to you, right? So every one of you, for the most part, I imagine, are diverse directors or executives on your firm. So this is a bad message delivered to you. Your company's probably already taking some steps. And so we had a catalog of, okay, what's next, right? And so none of these things, there's no silver bullet, but it's, first is disclose if you can. I mean, there's obviously, we understand there's personal reasons, but if you can, try to disclose it. And we know ISS will pick that data up. And many investors are starting to read this. So that means disclose it at both the director level, but also the management level, the named executive officers, the management level, and your full organization, the full workforce. Disclose ethnicity pay gap. We suggest you should set targets and measures of how you're going to prove it or disclose it or give us confidence of how you're going to get there. We think you should join industry initiatives, push your organization to join local industry initiatives. One of my favorite ones is, and you'll see new shareholder resolutions coming up this year, if you're a US company, is disclose EEO-1 data, which your company's already gathering. Right. Every company I've spoken to has said the way that they categorize employees, we don't like. And that's great. If every company tells me they don't like it, that means it's standard for us and for the government. And so that is a pretty good step. So I guess my ask to this group is, one of the things that we need to see companies that are leaders, so that when we're going after the laggers, trying to lift the minimum standard, right? So when I'm sending that letter, I'm just going after I'm going after global beer company in the US, I'm going after a credit company in the US. These are companies that have zero ethnicity on their board. And I'm saying, you got to do better. I want to be able to point to your companies and say, they have diverse boards, and they also look at this catalog of other actions they've taken, and hopefully you have a more engaged workforce, you've got good performance. And so that would be my
views. I think that makes sense. And one of the comments that was made a little earlier was on, a company like USAA, which, obviously has a huge component in the military, where you see an increasingly large Latino population, and yet, no diversity there. Esther was talking a little bit about what we've seen in California, where you've got 40% of the population being Latino, Latina, and yet, very little movement there. My youngest son is going through the college application process, and, for many of the schools, you have only 150 words in which to answer, which is perfect for the chairperson, a little bit more challenging for the IR team. But, the reality is that you should be able to, articulate what a strategy is and looks like, here in this day and age. But we were talking about the industries that have been impacted and what techniques people are starting to use. And, sort of Mark and John, you guys see this, you see poison pills, you see staggered boards, you see some other things. What are we seeing in 2020 where, what's the focus? What are some of the techniques and sort of a little bit of learning for this group here, as we tend to, try to drive best practices?
Do you want me to take that, Mark, or you want to go first?
Well, why don't you go ahead, and I'll join when you're done.
Sure. The number one technique in terms of, big picture technique, less so about tactic of how to be an activist. It's more to do with our position in the market, large institutional investor. What's our new practice is to be ultra transparent. So last week, we published our ESG score on every one of your companies. So if you right now go to Legal & General's website, you can go see our view of your ESG profile, the Legal & General house view. Now, we're not the only ones. I know many of our peers are starting to do that. And why is that so powerful? Well, now you as a company have a sense of where you stand. You can improve over time. And these viewpoints can then be leveraged as we're engaging with you or trying to track over time. It's a starting point that kind of can build off. This is also things we're building products off. So it actually drives actual capital. So that's, I think, if I were to say the biggest change and where, is this transparency. It used to be unknown. What's our real view of, what is the S really made of? Well, I can tell you precisely what goes into our view of your S score. and we'll even tell you the data source. So that's the big tactical change for us, and I think others will be following suit.
That makes my little G heart beat faster, because if you can't measure it, it's very difficult for the change to happen. And again, consistent with what Esther was talking about with the scorecards and some of the things that we're doing at LCDA. Mark, from your perspective?
Yeah, look, all of the traditional governance issues, independent board chair and majority voting and classification of the board and so on, those haven't gone away, but a lot of the energy these days is around environmental and social issues, because they're seen, it's not, hippie tree hugging nonsense. These are issues that impact the bottom line. They're risk mitigation, and that's how they're viewed by investors. They mitigate long-term risk. And those concerns are not going to go away because of a change in administration. They're not going to go away really for any reason that I can see, unless the government just sort of forces shareholders to stop voting in accordance with those principles. But I don't think that's going to happen, despite the best efforts of Eugene Scalia.
Yeah, no, I appreciate that. And, I think I will make a comment now. I'm going to take off a little bit my moderator hat. I am the chair and CEO of a private equity portfolio company that operates. So it's private equity, it's not public. And nevertheless, our board, and one of the first things that we did is create a sort of a sustainability committee to be able to address these issues. Either because we want eventually to sell the company, it'll be a concern to a potential strategic or other buyer, or if we were to take it public, to have been doing that from the beginning makes a difference. So Mark, I completely agree with you. As long as sort of shareholders are having a say, this is going to be an important issue. So perhaps the flip side of the question, and then I'll kind of open it up to all four of you to react, is the pandemic is not over. There's sort of this new COVID-19 reality, and again, echoing what Mark said at the beginning, it is more difficult for activists themselves now to mount campaigns, and they don't want to be seen as opportunistic in an environment where there's been a significant economic slowdown, where there's been sort of significant activity that has impacted people's livelihoods. And so the question becomes, what should we expect for the 2021 proxy season, and what are some of the areas where we think activists are going to focus as we kind of walk into sort of next year's sort of voting questions? Amy?
So,
go ahead, Mark.
If you don't mind, yeah, I was just going to say that compensation is going to be a big focus. There are a lot of companies that have made adjustments to incentive programs, that have made discretionary awards, that have repriced stock options, all kinds of responses to the pandemic. Look, some companies' share prices recovered very quickly, but others clearly still have not recovered and won't recover anytime soon. It depends a lot on the industry. It depends on a lot of factors. But wherever there's a huge disconnect between the experiences of shareholders or of workers and those of the executives, there's a potential for activism. Labor unions are going to be sponsoring vote no campaigns to urge shareholders to vote against pay programs at companies that have laid off workers while the executives still get paid.
Can I ask a question there, Mark?
For example,
do you
sure.
think that it'll have kind of a look back period? I mean, are they going to look at sort of companies that went out and said, look, I can't pay my workers if I don't have government support, but I happen to have paid my top 5 named executive officers $600 million of cash in the last 5. I mean, will it be a look back period, or will it be more like the stock, the repricing of the options, the sort of the resetting the bar after the fact, or is it going to be a little bit of both?
Probably a little bit of both. Look, I mean, look at companies such as the airline industry that have spent billions of dollars on share buybacks over a period of years, and then found themselves with no cash on hand when their operations were forced to be grounded. I don't think people are only going to look at the past few months, but certainly actions taken in response to the pandemic will be top of mind for a lot of people.
One thought there is,
sure.
And just to answer it point blank, Raphael, we put a statement to the press, Sasha Sedan, the head of our team, that's a little bit of the forward looking, right? So we will not be supporting any pay increases. This is at a minimum. We will not support any pay increases where there were furloughs or layoffs, headline across the board. So a lot of the details are still to be determined on exactly the look back element, but that's our public position. So that, sends a signal. So I fully endorse Mark's.
And you guys are very bright line, that is the line. It is the line. Perfect. Thanks, John. Thanks, Mark. Amy, I saw you come off mute.
Yeah, so a few different things. To your point of kind of what we're going to see for 2021 in the proxy season, I'd start by saying, echoing Mark's comments, right? So 2020 was a slower year in terms of public activism campaigns, and behind the scenes, I saw, and I'm sure Lawrence saw, a lot of situations that in a normal year would have become public but didn't. And what it's starting to feel like is that we're going to have quite a busy 2021 for a variety of reasons. But first, if we even just go back, look at what happened activism in the 2009 to 2010 period of time, post the financial crisis. Activism levels significantly declined because of the financial crisis, and then literally quadrupled in the following year. We're already starting to see that. If we look to even just within the last few weeks, it's already been a very busy Q4 in the activism world, which it isn't usually that busy this time of year. Usually the activists wait until we get a little bit closer to the annual meetings to make their campaigns public. It feels a little bit like they're chomping at the bit to go public with a lot of situations that maybe they hadn't done earlier because of this maybe reputational risk issue that they felt like they might have had in the 2020 proxy season. And the last thing I would just say on this point is what we have learned, to Mark's point, is that the activists that went public in 2020 went public and were very successful. And I think a reason why they were so successful is they knew they were going to win, and you wouldn't run a proxy fight in 2020 unless you knew you're going to win. What we're hearing and seeing, though, is if you look at the themes that the activists used in 2020, a lot of the thought process was, hey, this is the best example of a situation to show, like, you better have the right board and the right manager team in place, and kind of holding companies accountable to saying you need to have you can't take a step back, right? You can't say, oh, you can't hold me accountable now because the world changed. The point is to say, you should have thought about this. You should have everything because you're running a very significant company. And so I think once we saw that kind of theme resonate and be successful, I don't think there's anything holding them back from kind of pushing these campaigns for 2021.
Great. Thanks, Amy. Lawrence?
I agree with all that. I would also add that there are going to be a number of companies that were otherwise healthy going into the pandemic, much larger going into the pandemic, whose boards and management teams just proved that they could not lead through a crisis. And I think we're going to see complaints about those companies. Those are going to be ripe new targets on top of the regular number of activism campaigns that we see. And also for the industries like the energy industry, consumer, brick and mortar retail, hospitality, restaurant, that kind of what do you do outside of the home around other people? Those industries, lots of bankruptcies. But for the ones that aren't bankrupt, I think there's going to be consolidation activism. I think there's going to be a push.
Yeah, I agree.
Thank you. To be the last entity standing as part of a consolidation program, which probably is a delight to Amy, whose firm does a tremendous amount of M&A, and a delight to our M&A practice as well. So I think we're going to see that. And then what that could also lead to is activism around the M&A themselves, whether companies are fire selling or not selling for enough value or not combining with the right target. So I think it can give rise to incremental forms of other activism.
Okay, no, that makes sense to me. And Lawrence, you mentioned, and perhaps I'll still stick with you for a second. You mentioned, restructuring, right? I mean, there is going to be a fair amount of activity on the restructuring side. I'm sure our buddies at places like A&M and others are very busy, sort of helping prepare these teams to go through an 11, ideally maybe if not a 7. Are you seeing any activity on the part of lenders? And Amy, I'll ask you as well. BFA being such an important lender in the country, as they end up kind of perhaps holding a bit of an equity stake and having a say in how these companies look coming out of the restructuring in terms of what the board composition looks like, or is the focus so much on will we be able to provide the DIP financing and the liquidity needed for this to continue to operate? So just in the list of priorities, and having done some restructuring, I know it moves very quickly. Is that something folks are thinking about, or not so much?
Well, the lawyer answer is it depends. What we do find is there are a number of loan-to-own lenders out there, not Bank of America, of course, but the hedge funds that are focused on buying distressed debt. They will typically go through a restructuring and come out as an equity holder and designate directors in the pro forma post-bankruptcy company. And what's very interesting about that dynamic is it is not those shareholders do not have the same type of policies that Legal & General have. They're focused on alpha as quickly as possible. And a lot of times in these post-bankruptcy situations, you'll see activism. It's normally within the boardroom where the factions that are left from the debt holders are fighting over the direction of the company very soon after they emerge from bankruptcy. So you do see that. We've defended a number of post-bankruptcy proxy fights where we've won ISS and Glass Lewis recommendations, and it doesn't even matter. The debt holders that became equity holders are just going to vote, however they want, not aligned with any best practices policies. I don't think that bulge bracket banks like Bank of America are typically taking board seats. I've been involved in a few situations where they will designate someone that's independent and then completely wash their hands of it. But they're very concerned with looking like predatory lenders.
Yeah, that's fair. Okay, perfect. So I think we've spent a good amount of time focusing on something that is very important to the LCDA membership, which is so central to our mission, which is the idea of diversity on boards. And I think we've gotten some great perspectives on this. Perhaps as a last question for the panel, and then we can open it up for the members for additional questions. We are hopefully going to come out of the pandemic. We're seeing some good news on the healthcare side from Pfizer and Moderna and others. New administration. What are some of the other issues in addition to diversity that you think boards will be facing? And I think Mark hinted already at one of them, which is around compensation. But what are some other things that for those of our members who are sitting on public boards right now, perhaps for them and for their networks, they should be kind of having top of mind?
Well, I would say climate and companies' management of the risks, management of changes to the business model, physical risks of climate change as well, reputational, regulatory, all of that. It's clear that the Biden administration will have a very different approach from the Trump administration on these issues, but with potential Republican control of the Senate, I wouldn't expect any radical new changes on the regulatory front, which means that it will be private ordering. It'll be company by company, shareholders bringing shareholder proposals, shareholders voting against directors if they think the board is not appropriately managing the risks involved.
Great, Mark. John?
Yeah, I will definitely echo Mark. A very large initiative for us, our flagship position on climate is called the Climate Impact Pledge. It's been going on now for 4 years, and it does exactly what Mark mentioned, which was if there is persistent laggards on climate action, and that's based on a transparent set of a framework around disclosure, governance, metrics, lobbying dollars, et cetera, then we actually name companies and vote against their chairman in essentially like a protest vote that you're doing that poorly. We've had that for 13 companies have been like publicly named, and it actually has investment sanctions with all of our sustainability theme funds, but it does have definitely ripple effects onto the full suite of assets that we manage. We recently rolled that out again, back to that theme of using technology. We rolled out that climate impact pledge, which originally targeted about 80 companies to 1,000 companies across 17 climate critical sectors. So instead of just looking at oil and gas, we've now opened that up to airlines, to cement companies. So I think if you're a director and sitting on a company that, climate's important, but perhaps you're not an oil and gas company where you've already started thinking about TCFD reporting, like it is coming fast and furious. And I agree with Mark, that's going to be private ordering. And it's particularly going to be these investor collaborations that are going to move much quicker than government. And the power, I think, is going to be significant, starting with just disclosure, but it's going to move quickly from disclosure to strategy. And that shift is a massive shift of just saying, let's look at disclosure, to like, I want to see proof that your business strategy is aligned to, you'll hear the phrase net zero carbon emissions by 2050. Right. That phrase, that concept, if you're not familiar with it, would be something that I would recommend. And it's not easy to understand. I can, there's lots of little nuances to it, but just start, definitely put it on your radar. Just outside of climate, 2 or 3 other things that I think at least we're looking at, just to put it on everyone's radar. New ones. So these are very early. Public health and the role of companies in public health. And of course, we've had the opioid crisis. It's been an area that we've been collaborating on, but I think there's going to be kind of other spillover. That particular investor collaboration had gained a lot of strength, and it was very important. So that's an area that we're looking at. And another one I'll just kind of throw as a little bit of an oddball one, but I think I would just put on everyone's agenda is the role of tax, corporate tax. And I think it's going to be, because my prediction is that the analytics behind companies' contribution to taxes, it actually is the flip side of some of the pandemic, where they get government support, and then you're going to be looking at how much taxes companies have paid. So I suspect a brighter focus on that. I don't know how it'll actually play out, but it's just something that I think investors are going to start really snooping around.
Great. No, I appreciate that. And it kind of goes to one of the questions that I was going to ask in just a second as we open it up for Q&A. So as Ozzy mentioned on the chat, if anybody has a question that they would like to ask, you can unmute yourselves. You can come on video and ask the question, or you can send it in writing. But I'm going to use my moderator prerogative to just ask one more thing from John. And it's been, honestly, for me, a few years since I sat on boards either in Latin America or Europe. So I've done both, but it's been a little while. Are you seeing significant differences from your perspective between sort of, the way FTSE 100 companies think about it versus S&P 500 or some of the other areas in which you guys invest?
When you say think about it, you mean how they engage, or what issues are important?
Yeah, how they engage with activists. I mean, you've got,
sure.
Obviously you've got, German supervisory boards and other things that are a little bit wonky, but
yeah, so the number one difference, and so I'm responsible for the US, but all my other colleagues are sitting in London. The number one difference is access to directors, and it's shifting, right? So in Europe and in London, or in UK in particular, the expectation is that a director is on the phone, that you can send a very direct signal to that director. In the US, that's new. And it's unusual. So each company is thinking about it differently. I will, my pitch to this broad group is, if you're having trouble getting the attention of your investors, if you offer a director, that point blank, it increases the probability we will take that meeting. Now, the other thing I would just signal, when I always have this chance to say this, is for us, where it's not necessarily in a contentious moment. This is a little different if it's in an activist situation. It's very specific focus, and we're trying to understand pieces. It's totally okay to have blue sky engagements between directors and companies, or directors and investors. But at least for us and many of our peers, we put so much of our views out there in the public domain. We use ISS to help us implement our proxy votes, but we have a complete custom views. So our ask, and I think this is also different in the US and UK, is the UK or in Europe, they really prepare quite a lot better. The IR teams really understand exactly what your positions are, and they're just looking at that last little bit to try to understand, why they missed that vote. In the US, I think we still have quite a ways to go.
Great. Thanks so much, John. Mark, any thoughts?
Yeah, no, I would echo John's comments. We are definitely having more conversations, more engagements with directors than we did 10 years ago. Say on Pay has driven a lot of that, but increasingly the conversations with directors aren't just about executive compensation, but they're about sustainability, or they're about board leadership, other topics as well. And I certainly would echo the comments that if you want to get a meeting with us, with investors, it definitely helps get attention if a director is going to take part in that. And which director, well, depends on the subject matter. Compensation committee, audit committee, governance nomination committee, depends on what the key issues are.
Yeah, that makes great sense. And again, an asset that should be leveraged across the board. Perhaps Lawrence and Amy, just a question following up on the way that John highlighted sort of public health and tax. Honestly curious from your perspective, are there other things that are coming down the pike that boards are not quite paying attention to, but if they want to be the board that's ahead of the curve, they should perhaps start thinking about?
I'll start, and maybe Amy could tack onto it. This is nothing really new, but we're seeing this a lot with the companies that we're preparing and defending. It's an easy concept. It's called intellectual honesty. If you're not performing well, you need to get on a conference call at earnings and admit it and talk
Right.
about what it is you're doing about it. If you find yourself in front of ISS and Glass Lewis and John in a fight, and you haven't admitted that you had a few bad quarters, you're not going to get the vote. And your board is going to look responsible for that management team. So own up to mistakes. And you know what? It's perfectly normal to have made mistakes in the middle of a pandemic. It's a once in a century time where you can actually say, well, we had no way of anticipating this, but here's what we're doing to make sure it never happens again. Instead of saying everything's rosy, everything's perfect, our stock prices bounce back from the trough of March, April, but yeah, we're lagging one of our peers, our most major peer, but that's not a problem. We'll get past that. I think the intellectual honesty is very important. And just back to what John and Mark were saying, boards in the U.S. Need to be comfortable talking to investors. And
CEOs need to be comfortable in allowing that to happen
Right.
too.
Exactly right. We get letters, we see letters that our clients get on all the topics that we discussed, ranging from compensation, environment, to the S to the G. And oftentimes the board, it's directed to the board, and the board says, I don't want to sign a letter in response, kick it back to management. And just think about the message that sends. So what we say is, between quarters, there's no prohibition legally that I'm aware of getting on the phone with John and talking about governance. It's all public, it's all out there. So those are some of the things. They're not new, but
Right.
we're really putting pressure. And I'll let Amy tack on to that something more illuminating.
Well, I agree with everything that Lawrence has said, and I know Lawrence has heard me say this a lot too, but I strongly encourage every company I talk to get out there and get their directors to have some conversations with their shareholders. And still, I will tell you to this day, it's shocking to me how many are kind of surprised by that recommendation. But even beyond that, when we think about I'm less concerned actually these days about convincing companies that, what to do that's better than the rest or whatever it may be. If we think about just the companies that are being targeted by activists, it's actually been a huge shift. It's no longer the companies that are doing a lot of things wrong. In many cases, what you're seeing is the companies that are doing all the things right, but still, for whatever reason, their stock isn't necessarily as high as you'd want it to be. Those companies are still being targeted by an activist. And just to give you some perspective of kind of what some of those names are, I think Starbucks, Disney, they have activists in the stock today. And they're phenomenal companies that are, really well operated. And so the point is, and I say this to every company I talk to, even if you are a great company, you can still be the target of an activist, because more and more activists are concerned about their downside risk than they are about the upside, which they're convinced they can create in the stock just by the presence of them in the stock. And so more and more of the conversations I'm having is to say, you've got to be thinking about this from a very holistic perspective, because only if you are doing all the right things, you can kind of operate with them somewhat under the radar screens, and hopefully the stock will go up and they'll move on. But if there's things that they can manipulate, or there's things that they could take advantage of, they will. And so you need to make sure you're doing all of these things well before they arrive.
Yeah, no, I think doing that makes a ton of sense. And there's the desktop exercises that are a lot less stressful. You pucker up a lot less when it's on the desktop, but it actually helps you anticipate where something might happen. I saw in the chat, Esther, that you had a question, so please go ahead.
Yeah, I have a quick question. So, the World Economic Forum has had lots of discussions around ESG in general. And sometimes my worry is when there's sometimes a global approach to ESG, then the nuances of how ESG should be structured in different countries, I should say, and in particular in the US, our demographics and our, kind of societal factors are different than maybe European countries. And we've had lots of discussions with large institutional investors and some who invest globally would say, well, we're not going to get into the weeds on in the U.S. around this was just a year ago, it might have changed now, around race, ethnicity, because we're a global investor. And so, John, are you seeing, do you guys have like a tailored ESG plan, especially the S part, as Rafael said from the beginning, that S is taking a central role. Are investors tailoring their ESG plans to kind of accommodate the differences in countries, especially on the S front, or do they lump it all together?
So that's a really hard question, and I can speak from a legal and general's perspective. And this is important, is how ESG data is used in a large, diversified asset manager. There will be many different ways that we think about that. We, legal and general, tends to look at the world from a minimum standards perspective, because we do have portfolio managers internally that are trying to create alpha because you have a particularly more diverse workforce, and that might help you with retention or getting into new markets or something like that. But that's a pretty hard argument. The way we think about it from a stewardship team is trying to drive disclosure, look at minimum standards, and raise the bar. When we're building index products, we have an ESG index series that is trying to help investors who want to build beta, build market exposure, and actually like systematically exclude people who have bad performance. And then, of course, we have active managers that are trying to use ESG to outperform. Point blank, do we vary our S analysis by country? No, we don't. There are ways you could do that, and I think the thing that I'm excited about, I think so. You mentioned the World Economic Forum. They're proposing a set of ESG standards, which has maybe some similarities or not to SASB. I think it's probably worth mentioning SASB. SASB's had a tremendous growth, and I think there's a lot of. And the big question is how adopted is it going to be on a global basis? And I think the jury's still out. But there's a ton of positive momentum. For sure, the large institutional investors are behind it. A lot of corporates are behind it. But now it's kind of, you have the WEF, the IFRS, and the accounting standards are starting. So this is a really interesting reckoning moment in terms of future standardized disclosure of environmental social governance information. But I just wouldn't mismatch that disclosure part of, like, let's say the World Economic Forum says this is what the disclosure is and how investors are using it. So investors' use cases kind of vary quite a bit.
Super quick. So the reason why I ask is because, we advocate for disclosure that breaks up, so we don't have, underrepresented groups or minorities lumped into one group, or, people of color. We want to see the data disaggregated by, Latino, African American, Asian, because there's a huge variation. And, I think a World Economic Forum probably, I don't know, I haven't seen I'm interested in seeing theirs. They probably wouldn't advise or have the sensitivity to know that, hey, we need to drill it down, because you just can't lump. It's hard to gauge how a company is doing and need that kind of disclosure. And of course, Mark and ISS, at least, for the US, their data does break it down so you can find out, of the Russell 3000 companies, where do the different demographic groups go. But if it's kind of a macro, hey, measure the S and measure diversity on your board, everyone's going to say gender, and it's been gender for a while. And hopefully what we want to see is that breakdown. And that was, something that we're keeping an eye on.
So I think we've got the last 5 minutes, so we're going to wrap it up here very quickly. Just perhaps one last question, because it comes from both Joseph and Rich. In just very high level, very quickly, from a metrics perspective. So what are, as we think about ESG broadly, what are the 3 or 4 key metrics that people are focusing on? And I was thinking particularly from the investor side. So John and Mark.
John, you want to take that first?
Sure, I'd say, you can't ask the question that way, right? The flip way to answer that question is whichever metrics the company's falling out of norm with is the one that we're going to focus on, right? So it's just, ESG is a bad amalgamation. That's the best grouping we can, right? So for us, if you have a combined chairman CEO, that's a real big problem for us, which may not be the same for every investor. So that creates a flag. Right? If your carbon emissions are 3 times your peer set, that's going to create a flag. If you have zero diversity on your board, that's going to create a flag. So there's not one, it's whatever one is way out of whack. And then one other comment on that, because it's one thing that's really important to me, and I know we got a big group of directors out there. One big question I always hear is like, what if we disclose something and we don't look good relative to our peers? The big trend among investor community right now, we're comparing you versus your peer set. The big future trend that I think will happen is comparing yourself versus yourself. Every company has kind of a unique profile, and there's going to be this shift that happens. And so just keep an eye on that. But, that's my thoughts on that one.
I like that, you're going to be pushing for continuous improvement no matter what, right? Yeah. So perhaps maybe 30 seconds from Mark, Amy, and Lawrence before, we wrap it up. John, thanks so much for the feedback.
So I would just say, to get back to Esther's point, in a way, the metrics are going to differ from country to country. There are countries such as France where it's not even legal to disclose, to break down ethnicity and disclose ethnicity of employees or directors. And of course, diversity in society and underrepresentation of groups within society is a very different question depending on what part of the world you're looking at. So while investors around the world have an interest in diversity, what that means in practice is going to differ significantly, I think, from market to market. Climate, on the other hand, is something that is of interest to investors in just about every part of the world. And obviously data isn't as easy to come by in China as it is in the UK, but the underlying concerns about what companies are doing or not doing on climate are common to investors around the world.
Great. Thanks, Mark. 30 seconds, Lawrence, Amy.
Sure. I would just say, I think I'm in the unique position where I can come in and actually tell a board the things that they should be hearing, as I mentioned before. And a lot of that's led by the stuff that, Mark's saying and John's saying. And I would encourage directors to actually try to get that independent perspective, because it is not so easy for the management teams to tell them those things. It doesn't always make them look good. And I'll be honest with you, the management teams are actually really happy when I go in there and say those things, because it helps to drive that change. And so don't don't assume you're hearing everything, not because management team's hiding it, but it's just not an easy message to give.
Yeah, that makes a ton of sense. I've seen version 1 and version 50 of the PowerPoint, so I hear you on that one. Lawrence?
Yeah, sure. 2 points. One, everyone should remember the famous words of Ed Koch, the former mayor of New York City, when he ran for re-election in the early 80s. How am I doing? Every director should be asking that question. But the good news is that you have answers. Get the data. Go to ISS. Go to Mark. Go to John. Look at your annual meeting results. Then call Amy. Amy will tell you to call me, and we'll help you through it. I think the other thing directors need to be doing is asking questions of management, and then questioning all the answers. Don't take anything for face value. Scratch beneath the surface.
Great. Awesome advice, Lawrence. Thank you so much. So we've got just a couple of minutes left, and that's just enough time for me to thank our superstar panelists, Mark, John, Lawrence, Amy. Spectacular discussion, really appreciated the interaction. And I think, I speak for all of the participants in just a big thank you. I wanted to thank BNE and B of A also for sponsoring the session. So thank you guys. KPMG always for being such a backer. The engagement from the participants and the questions that came in. Please fill out the feedback form. And finally, Esther, thank you for pushing me to host this thing. And if you have any last thoughts.
Hey, happy Thanksgiving, everyone. Hope everyone stays safe. That's the most important thing.
Yes.